Our first speaker to kick off this wonderful Elliott Wave Hub event is Sid Norris. Sid Norris has been an investor, trader, and market student for over 30 years. Since 2010, he's shared market forecasts at ElliottWavePlus.com, where he's known for enhancing Elliott Wave theory by integrating Hurst cycle analysis to reduce bias and improve accuracy. Sid's topic this time is 2025, a year of dramatic trend changes and market rotations. Welcome, Sid.
Good morning, good afternoon, good evening, wherever you may be. This is Sid from Elliott Wave Plus, and this is the biannual Elliott Wave Hub July of 2025 presentation that I'll be here for the next hour. And before we get started, I wanted to show my disclaimer as well. So to read my disclaimer in full, go to my site. It's ElliottWavePlus.com. Scroll to the bottom of any page at the site. Click on the Terms of Service Disclaimer tab down there, and there it is. It's there all the time. If I were to summarize it in one sentence, it would be there's risk of loss in all trading. So I'm going to open up a document here now and show you kind of an idea of, if I can get this, here we go. So this is kind of a outline I prepared as much for myself as for you guys. And the title of my presentation for this hour is 2025-2026 will be a period of dramatic trend changes in market rotations. And I'm going to show you a bunch of charts and Elliott wave analysis that includes Hurst analysis. And we'll cover why I think the rotations are going to occur. And I'll show you charts that indicate what the possible rotations are going to be. Before we get started, my name is Sid Norris. I'm with ElliottWavePlus.com. You already saw my website. Please go there and you can read about me and my history and my site. I've had a paid subscriber service since 2011. Most of my subscribers have been with me for many, many years. And I do have a unique way of analyzing the markets because I combine Hurst cycle analysis and Elliott wave and kind of marry the two together to develop wave counts. Of course, I use Fibonacci price targets and a number of other tools, including and very importantly, sentiment. So I've developed some sentiment screenshots that I provide to premium plan subscribers every day on the daily sentiment charts and every week on the weekly sentiment charts. We'll look at some of those. Very quickly, I want to go back this year to April. In early April, I was hugely bullish on just about everything. And if you would like verification of what I'm saying, you can go to my Elliott Wave Plus YouTube channel. And there's the my weekly counts webinar that I posted at YouTube on April 19 that included all price action through April 17. And so that's my YouTube channel where I occasionally post things, and pretty soon I'll be posting my quarterly premium plan channel later this month there. But I want to start getting into some of the slides I prepared for you. I was forecasting upward movement in the stock market. It was wildly bullish there in early April. And the cycle forecast at that time was for upward movement through all the way into July. That cyclic forecast turned out to be quite accurate. The forecast was also supported by weekly and daily sentiment screenshots we provided to premium plan subscribers. So I already showed you the YouTube channel, and now I'm going to get into some of the actual screenshots I prepared for you. The first one is, I'll bring this over. This was my Elliott wave count on Dow Jones Industrial Average, and this was on April 9 of 2025. So on April 9, that was the very day that we got that 3,000 point up blast in the Dow Jones Industrial Average. And I had been waiting to see if we would get a move down here into the price territory of wave one. So up from the 2020 low up through the January of 2022 high. I've been counting that as wave one of a diagonal and a two of a diagonal, three of a diagonal, and but we had never dipped enough to actually cross into the price territory of wave one. That's a requirement on diagonals, and that dip down into early April actually did manage to overlap there. And at that point, we were getting a legitimate possible wave four, but that wave four of a diagonal needed to be a three-wave structure, not a five. And that's the way it turned out. And so on that very day that we got that big bounce, I decided that that very likely was an 18-month cycle trough and that we were going to move up in the fifth wave of the diagonal. In other words, the fifth wave up from the March of 2020 low. And that had begun. And that each leg of a diagonal is typically an ABC zigzag. So this was my chart that I sent to out to subscribers on April 9. At that same time, so this was actually April 5, a screenshot of my weekly sentiment conditions that I had sent to my subscribers. And what was going on was very nicely predictive, just simply looking at sentiment. And so what I do with my sentiment, proprietary sentiment conditions templates, is I look on the weekly at a 12-month look back on commercials positioning. And you'll notice that commercials had started to get long the S&P despite this significant and massive price dump down into early April. And the conditions were very near what I call a perfect storm of bullishness. So a perfect storm of bullishness on a weekly sentiment chart from us indicates that the commercials are heavily long at the same time as retail is heavily short. So retail traders are typically dead wrong at major turns in the market. And and on this, as that week ended, that first week of April, retail traders had gone all the way down to only 10% bulls. Well, the last time we had seen only 10% bulls out of reading from the retail sector, your individual traders, small traders, was back here, right there. And that was at the very low tick there. And the last time before that we got down to a 10 or below was at this low back here. Just a week prior, I would say, to the bottom tick in October of 2022. So this is a template that I produce on over 20 items, on 20 tradable items for premium plan subscribers every week. And so this was very nearly a perfect storm. What was not perfect about it? Well, the commercials on a 12-month look back weren't quite in the green zone yet. They were close. And what that means is when they move into the green zone, like back here, that means that they are as long as they have been at any point in the last 12 months. So this was, I had made this note. This is an actual just copy of the screenshot that I had sent out on April 5. And then on the very next week, on April 11, my template had automatically thrown up this green stripe. And what that green stripe basically is saying is that therefore a short duration, the week prior, the money flow indicator was above the RSI. The RSI was in its oversold territory, but the money flow indicator was above it. And then when that condition releases, and they both are moving up out of their oversold territories, it throws up a green stripe. Well, as you can see, there was no other green stripes that had appeared for a full several years prior to that, and so that was something that my an indicator I programmed up, the money flow versus RSI indicator, had thrown up that green stripe. Also, notice the thick green box that had appeared around price. That means that the commercials on a 12-month look back had moved into the green zone. And we were just off of retail being only 10% bullish. So this is a perfect storm. Commercials heavily long, retail heavily short, starting to move up, and some volume coming in. And this was on April 11. So then, according to my system, the very next green candle would constitute what I call a perfect storm of bullishness. Here's the weekly screenshot the following week. This is on April 18, and we got the green candle. The green candle is base color is determined by the slope of a 3-period moving average of the DSI, the daily sentiment index down here. So those 3 successive charts really had warned ahead of time and confirmed that we had likely put in a large cycle low there. And then I did a YouTube post that basically was my April 19 full recording of my weekly counts webinar that I do for Pro Plan and Premium Plan subscribers. Once a week, I go over everything with a fine-tooth comb. It's a 3-hour deal. And this was my wave count at that point, that this very likely was the 18-month cycle trough, and that we were going to move up in an ABC zigzag to put in the 5th wave up, and Hurst. And this is something a lot of Elliott wave people need to get used to when they look at my charts, is I always have these CL dates. That means CL stands for composite line. Hurst was bullish out of this 18-month cycle trough until mid-July. And this is all the way back on, includes only price action through April 17th. So on April 17, Hurst was bullish from mid-April through mid-July next. And I think that's rather amazing, frankly, and just pretty spectacular. And so that really exemplifies how I called that low. I've warned of the low and predicted upward movement in the stock market from early April all the way into July. Okay. This next chart is now. So this, I took this yesterday after the close, and this is kind of a single chart view of several important measures in the stock market. And you'll notice that there's several, the black line is the S&P. This indicator here is the put to call ratio. And it includes several thresholds that are very important. And when certain thresholds are met, if the put to call ratio is very, very high, Then it throws up a green stripe, and then and if the put to call ratio is extremely low, it throws up a pink or red stripe. Those green's bullish, pink or red is bearish or toppy. The second indicator down is the daily sentiment index, which is a measure of the percentage of retail traders that are bullish or bearish. Or what their percentage of them that are actually bullish. So at this low right here, with that thick big green triangle, and that actually came in a few days prior to that low. It was a warning that we're getting into a buy low situation. The retail traders were only 10% bullish. Last time we got any kind of buy indications, screening buy indications, was back here in August of 2024. As you may recall, that moved down into early August, was based on the beginning of the yen to carry trade unwind. There was one other buy signal that came out right here as well. And this only puts out warnings of extreme oversold and extreme overbought. The bottom indicator down here is the cumulative advanced decline line. And that throws up these dark red warnings when it meets certain thresholds. And up here, it puts a dark red thick box around price, indicating that we're very likely quite toppy. And so you'll notice that back here, it was giving warnings of toppiness, although not all three of these indicators weren't throwing up those warnings. But now we have all three throwing up warnings just recently going into this top. So this was a warning that we were getting extremely, extremely toppy, and there was we're very unlikely to see much more upward movement at this time until some of this frothiness works off. So when this dipped down below the 0.75 threshold, that threw up the pink stripe. When the 87, anything above 85, it throws up a triangle here. And then anytime this is above a threshold of 6,200, it puts a thick red box around it. So lots of warning signs recently indicating toppiness. This is a chart that goes out to premium plan subscribers every night, updated. And it goes out I show it during the weekly webinars for Pro Plan uh, subscribers. Here's some other interesting developments here recently that have indicated that we're very near an important peak. One is if you look back at the topping process that occurred late last year, the high from November actually is still holding in the Russell easily. But that black line right there is the equal weighted RSP, the equal weighted S&P. The purple line is the actual S&P 500, the ES contract. And I've got them both set on this overlay chart to start about the same level in October 2023. Well, the equal weighted S&P was doing very well up into the late November all-time high at that time. But then it came crashing to the downside, whereas the market cap weighted ESP that's overloaded by Mag 7 stocks didn't really collapse as much at that time. And then at the peak on February 19, you'll see that the market cap weighted S&P, which has a high percentage, maybe 1/3 of it is just the Mag 7 stocks now. made a new high, all-time high there, but you'll notice that the equal weighted S&P was not coming anywhere close to a new all-time high at that time. So that meant that the breadth was terrible. It was profoundly off. That the we'd see a new all-time high in the S&P, but not in the equal weighted S&P. Well, then they crashed down into April. And by the way, these colored stripes are also being thrown up by my proprietary money flow versus RSI indicator, and they're automatic. And then we've had the recent move to the upside. The final leg of this move to the upside, and by the way, it looks like a 1, 2, 3, 4, 5 wave structure, was accompanied once again by the same thing that happened in February. And that is that the market cap weighted S&P was screaming to new all-time highs, whereas the equal weighted RSP was lagging. That, that the last time that happened at this kind of spread was in February of last year, and was followed by a substantial move to the downside. I think what we saw yesterday with the big down day is the beginning of a larger move to the downside based strictly on just examining the what has been keeping the market up and what has not. So this is my current wave count on the S&P. So I'm going to show you the current wave count. This is the quarterly candles. This goes all the way back to the 1932 low. I've showed this many times, and from the 1932 low, a cycle degree 1, 2, 3 in 1966, 4 in 1974, and then a massive fifth wave up, an extended fifth wave up from the 1974 low that includes a primary or burgundy 1, 2, and 3. Notice that the third wave there was heavily extended. It was a 4.236 expansion off the size of wave 1. And then we got an expanded flat for wave 4. And now after on the burgundy colored numbers, when you've had an extended third wave, you would expect a normal fifth wave, not another extended wave. And so the best target for a normal fifth wave up in the S&P was back at 49.31. That has been hit. That got hit back in here early in the year. And so on the S&P, it has overshot 3 different large degree Fibonacci targets that were set based on price action starting at the 1932 low. So if we examine the price structure up from the 2009 low, it's, I think, pretty obvious that we got a 1, 2, 1, 2, 3, 4, 3, 4, and now we're in the fifth wave up. Notice that the wave 3 was extended. It was a little longer than 1.618 times the length of wave 1. So once again, we've gotten an extended third wave. Then we got an expanding triangle for fourth wave, very unusual structure. And now we get a fifth wave up. Once again, we would not necessarily look for an extended fifth wave up because usually, most typically in the stock market, one of the odd numbered waves in an impulse is extended, and it's almost always the third wave. And so once again, we have an extended third wave looking for a normal fifth wave, and that target was right here at 54.05. Well, that also has been overshot. But we still need a completed 5-wave structure up from the March of 2020 low. So that's where we get to the weekly chart up from the March of 2020 low. 1, 2, 3, and then in almost all items, we got an overlap down in here for the fourth wave, down into the price territory of wave 1. So this, I think, counts best as an ongoing and unfinished ending contracting diagonal. Each leg of a diagonal is typically an ABC zigzag. And up from the April low, I believe we have completed a 5-wave up structure. So a zigzag is a 5-3-5 structure. Notice that Hurst is still calling for it to top in July. This is the same month that it was calling for a top. Um, Going back to the analysis back in early April. So Hurst has been, the cycle analysis has been rock solid and good. And that's what I do, a combined cycle analysis with Hurst. This is the daily chart, and this is current. And so there's the 18 months, last 18 month cycle trough. That's Hurst terminology. By the way, with you know, each 18-month cycle, so the last 18-month cycle in Hurst was in October 2023. Each 18-month cycle consists of two 40-week cycles. And so, and then each 40-week cycle, so this is going to be a 40-week cycle, consists of two 20-week cycles. And each 20-week cycle consists of two 80-day cycles. And so I've put this manual phasing cycle finder down here to basically exemplify for you how Hurst works. And so 80 days, first 80-day cycle probably done. We're in the second 80-day cycle, and therefore this, by the time this finishes a 20-week, that would complete a 20-week cycle. Well, the 20-week cycle is due in mid-August. This really hasn't changed much either. If you go back to those old charts I was showing, it was looking for a top in July and a bottom in early September. So these dates have hardly, they do morph a little bit as time progresses, and I cover them for my subscribers on the Wednesday and Sunday screenshots. And so these dates do morph a little bit as they adjust slightly to ongoing price action, but it's amazing how predictive the Hurst cycles can be. What we're seeing recently is a good example of that. Notice that I have this buy low moniker that I've or label I put down at this April low. And if you go back and look at my video I did way back in April, yeah, I was coming up with dozens of buy low candidates at that low in virtually every category. Almost all of those has gone up from that low. It's been a universal, and suggested that it would be because that 18-month cycle trough or large cycle trough was due and probably in there in April in virtually everything. So the count up from that low is a 1, 2, 1, 2, 3, 4, 3, 4, 5. We probably have reached the peak. And one of the reasons I'm suggesting we probably have reached that peak is because of sentiment that I already showed you, all the sentiment, the put to call ratio, the advanced decline line, all of the warnings. And so what I'm expecting is a 5, 3, 5 structure, and not expecting the final high on the S&P until September, maybe into October. And I've got a target zone up here of anywhere from 65.10 all the way to 69.46. 69.46 would mean that the wave C, this would be an A in pink, B in pink, C in pink, would be a 0.382 expansion of the length of wave A. So I think we'll get a pullback here. Am I absolutely certain that we'll get a zigzag for a pullback on this wave B? No. It could be any corrective structure. It could also be a flat. It could be an expanded flat. This wave B here might make a slight new all-time high there. But it should be corrective. And by the time we get to mid-April, we should have another buy low condition for the final impulse, 5-wave impulse to the upside into that high. So there's a quick Notice the divergence that we're seeing on the daily chart on the RS or the MACD histogram, extreme overbought territory, the Hurst cycles. The DSI, that's the retail sentiment, is at an 87 or was at the top tick here. The last time we got a reading nearly as high as that was right here. And a DSI of 85 right there. And that occurred back in December of last year. And you can see that the market had virtually zero upside potential left once it reached that level. Yeah, it did sneak up a few ticks and but it really spent more time below that than above it by the time it put in its all-time high in the S&P in February. So the conditions are ripe for a pullback. Now I want to move back to, then let me go back to my document. So I've showed you the S&P, I've showed you the Hurst analysis, I've showed you the sentiment suggesting that we're about as high as can go for now. Um, and that we're likely to get a B wave correction. So now we're on to number 4 here now. Several of our ratio charts suggest that a dramatic change in market behavior is imminent. A rotation from FANG and AI stocks to energy-related commodities and stocks. Fundamental support for this concept can be found at, and I want to show you that this are a couple of natural resource money managers that I think really do a great job of a constant deep dive into energy and natural resources. And this latest edition or blog post is called Peak Shale Amid Maximum Pessimism. I would highly recommend you go to that and read that. Um, and there's a audio version of it you can listen to, and it does a fantastic job of providing fundamental support for the idea that that I'm going to show you next is that we're going to get a rotation out of the stocks that have been leading for years now into energy related like crude oil, natural gas, coal, and shippers that ship those things. So here's what the first chart I want to show you that talks about that. This is the FANGs to IXC ratio. So FANG stocks, we all know what those are now. And the IXC is an ETF that includes global energy stocks. So it's large cap energy stocks like ExxonMobil, Chevron, BP, Total, Shell, and it doesn't include just the U.S. owned or U.S. based large cap oil stocks. It's the largest cap oil stocks around the globe. IXC. And when you look at what's happened here since November of 2022, I think we have a pretty obvious 1, 2, 3, 4, 5 wave structure. These dates that I am showing on here are based on the Hurst analysis on FANG, FNGS. It's projecting that we're going to get a top in FNGS here in July, and that the FANG stocks are generally going to move down for the rest of this year. Then they'll rebound into March, April of next year, and then be quite bearish after that. Now, remember, this isn't just a chart of the FNGS. This is the FANGs to AIXC ratio. So if we completed a 5 wave up structure on the FANGs, we're going to see the FANG stocks weaker than the energy stocks for the next several years is what this is suggesting based on that LA wave count. Well, you might say, well, yeah, the FANG stocks are looking, that's old news. What's really driving the markets today is AI. Here's and the AIQ ETF to the same global energy stocks ratio chart. So this is AI stocks priced in global energy stocks. So starting at the November 2020 high, we saw a clean, clear five-wave down structure, complete with a bullish divergence, what I call the 3-5 divergence, down into November of 2022. So the AI stocks are actually moving down against energy stocks until November 2022. And then the rise since then in AI stocks looks like a zigzag, a 5-3-5 zigzag. And up from October of 2023, it looks like we have a 1, 2, 3, 4, 5. Now I've used some Fibonacci targets for the best target for the end of this 1, 2, 3, 4, 5 green here. It hasn't hit it yet, but it's starting to look very weak. When I do a Hurst analysis of AIs, this AIQ, the AI ETF, it is projecting that they will top here in mid-July this month and be weak for the rest of the year, then up through April of next year, and then on down through into the fourth quarter of next year. So once again, a 5-3 potential move to the downside. This suggests that we're going to get a rotation out of AI stocks, which are bubbled. Those are in a bubble, just like the FANG stocks are in a bubble, into something that is not in a bubble at all, energy. Here's some additional food for thought on the fact that growth stocks, yes, recently have been outpacing value stocks. So the peak first occurred in November 2021, moved down through January 2023, and now recently made a new high. But while growth stocks priced in value stocks has recently made a new high, look at this massive divergence, bearish divergence that is setting up on this weekly chart. Matter of fact, when I draw a support line on the RSI here, it broke down here and then came up to the underside of the broken trend support line. And we have a divergence between this high and this high as well. This also suggests that we're going to get a rotation out of growth stocks into value stock. This is quite the opposite of what they talk about constantly every day on financial propaganda TV. And all of that is what I call narratives, Wall Street narratives. What I'm showing you here is actual charts. This would be scientific evidence that we could see this rotation, even though no one is expecting it. So the rotation, this is a chart I just threw in here, so you would to see that when you price the S&P in gold, the all-time high from back in the year 2000 continues to easily hold. So this is the S&P priced in gold. And notice from that 2000 high, we got a 5-wave down, clean, clear 5-wave. It's amazing when you do these ratio charts and you use gold as your comparison item, you get clean Elliott wave structures. Why? Because gold's real money, and the U.S. dollar is basically shifting sand as they and is an unfirm foundation for pricing what's really happening to many items. So a clean, clear 5-wave down structure, even within this wave 3, 1, 2, 3, 4, 5, a triangle for 4. So this bottom in August of 2011. So what's happened since then? 1, 2, 3, 4, 5 for A, 3 waves down for a B, and then a slight new high, December 2021. And now, between that time and February of 2024, it formed a head and shoulders, and now it's breaking to the downside in wave 3. So this suggests that we're going to see gold continue to outpace the S&P. In other words, the S&P, when priced in real money, is a lot weaker than what it looks like when you look at it all by itself. So when I'm talking about this rotation that would occur out of the stock market leadership and into commodities, here's an additional support for that idea. So in April of 2020, that's when crude oil basically moved almost to zero, basically. And on the front month contract actually dipped below zero for a little minute. That was the all-time low in energy and material stocks as far as a percentage of the S&P. By the way, that energy and material stocks back in 2008 constituted 17% of the S&P, and at that low, only 2.1%. That was also, if you look at a much longer chart of this using much longer data set, that low was probably the end of a very large degree, fifth wave, down from the 1942. So it started back in 1942. So at that low, commodities were dramatically cheap, dramatically underpriced in comparison with the stock market. So and since then we got the move up out of that low in commodities up through June of 2022. And now it's come down and essentially kind of made a double bottom in December of 2024. Notice that this chart moved down in a channel and bottomed in December 2024. So just 6, 7 months ago. And now has broken up out of that channel. From an Elliott wave standpoint, I think that this is a sign that we're going to move into a wave three. This would be a one off of a significant and major low, a one or possibly an a two, a very deep two or B, and then we would get an impulse to the upside on commodities versus the stock market. So this supports the idea that we're going to get this rotation. Now, is it going to happen all at once? No, they're going to have a process that it goes through down here, like a 1, 2, 3, 4, 5 wave leading, expanding diagonal and a dip down through late in this year before it gets into the wave three to the upside. Here's the Dow Jones Commodity Index. And I did a combined Hurst and Elliott wave analysis on this. And there's that March of 2020, actually. Actually, that low was, yeah, March of 2020. I think that was wave two of an ongoing diagonal. Then we had the move up into March of 2022, wave three of a diagonal. Four of, actually, it's not a diagonal. It didn't overlap. This is a actual non-overlapping five-wave impulse. 1, 2, 3, 4. So this low recently occurred back in the third quarter of last year. This is the commodity index. This is the catch-all of all commodities. And I think we're getting a 1, 2, 1, 2 setup, a basing setup that will end about the end of this year. And we'll see commodities dramatically move dramatically faster to the upside than the stock market will be. There's an analog that I think we can look at and look at what happened back in 2007, 8 on commodities, especially crude oil versus the stock market. So notice that Hurst thinks that this is going to rally and commodities are going to be strong, say strong all the way through 2026. Well, as you already seen on my charts on the S&P, I think we're going to have a possible recession on stocks in 2026, primarily due to the loss of the leadership in FANGs, where FANGs are constituting such a high percentage of the index now that if we lose that leadership, the index, I think, has no choice but to go down, considering how much percentage of the index is in those FANG stocks now. But notice I was expecting the stock market on some of the earlier charts to stay up. Let me go back to the S&P daily. So I'm expecting a move down through late in this year and to move up into February, let's say March timeframe on the S&P chart. And then when we go to um, the commodity index, that is I believe, going to be the point of departure between commodities, especially crude oil, and the stock market. So the stock market should move down strongly through late 2026 from there, but the commodities, especially crude oil, move higher. The same thing happened in uh let me see if I find that chart. The same thing happened on crude oil back in 07, 08. The S&P topped in October 2007 and started embarking on the crash, the financial crisis crash down into March of 2009. But you'll notice that crude oil continued to bubble and scream higher in a blow off top all the way through July of 2008. It was that continued blow off to $147 a barrel that contributed to the subsequent stock market crash. So oil kept moving up while the stock market was beginning a crash, and it just became an untenable situation where energy had gone up too much and the economy couldn't handle it. Um, and I think we're likely to get something similar toward the end of next year. And this is all using a combination of Hurst and Elliott wave. So this is crude oil price and gold, and notice that crude oil's been moving down aggressively since June of 2022 when priced in real money, gold. But look at the Elliott wave pattern. Up from April of 2020, 1, 2, 3, 4, 5 waves up through June of 2022, followed by a 5, 3, 5 corrective zigzag, pretty deep. And that final wave C of the zigzag completed a 5-wave down structure and kind of capitulated there in May in crude oil. And now it's starting to rise up from there. I think we're going to see crude oil move up much faster than gold. How about natural gas? This is a monthly chart of a natural gas price in gold, and natural gas since March of 2024 is also moving to the upside when priced in gold, real money. And I think we'll generally consider see natural gas moving higher through March of next year against gold. So so if crude oil is going to be a big winner here, um, uh, what's my wave count on crude oil? Well, it's rather shocking, I must say, that up from the April of 2020 low, which actually bottomed much lower than pictured here, we got a 5-wave up structure in crude oil. That has to be the beginning of a bigger move because uh, you look back at the monthly chart. There's that capitulation low in April of 2020, 1, 2, 3, 4, 5. So that was such a low, low, low. If it begins with a 5, then we're going to see a C wave to the upside, and we could see a spike in crude oil that would just absolutely be shocking. Um, So 1, 2, 3, 4, 5 waves up through March of 2022, followed by a sideways ABC structure, overlapping corrective structure that likely ended in April. This is one of the things I was saying was a buy low candidate was commodities in April, and notice that generally looking to the upside on crude oil for the next 2.5 years. And if it moved up where and it was simply in an ABC, And the C wave was a relatively conservative 1.382 expansion of A that would take crude oil to $400 a barrel. Now, most people look at that and say, that is ridiculous. You are insane. But I want to, I prepared a quick narrative that I wanted to show you about how that is actually possible. So the news came out just yesterday that the OPEC is going to increase production. There's a reason why they're doing that. Once again, go to this site, gorozin.com, and read this blog post, and it goes over the history of U.S. shale production and OPEC and these major turns that have occurred in the oil market before. Despite the projections, the incorrect projections in recent years, the demand for oil has actually continued to rise. This is something you won't hear on propaganda financial TV, but it's true. And but there's been several CEOs from Diamondback Energy and Occidental Petroleum and others that have been talking about how we are past peak shale. In other words, the U.S. Permian and other U.S. Drilling sites, they are past the peak of what they can produce. So OPEC recently has been pressured into announcing increased production. There's a reason why that just happened, and that is that the U.S. is running out of oil. There's a depletion factor where they just can't produce it as fast as what they had been until recently. A lot of these wells are running out of oil and gas to produce. This same thing actually happened where OPEC promised to increase production in the early 1970s. And it didn't lead to lower oil prices, it led to higher oil prices. Why? Because what's really happening right now is OPEC is quickly regaining its market share again on crude oil because the U.S. is tapped out and is therefore achieving pricing leverage. So this may not happen overnight, but I think it's going to happen, and the same as it happened in the 1970s. In the early 1970s, OPEC used their market share monopoly to increase the price of oil tenfold in just 5 years, from 1970 to 1975. And by 1980, the price of oil had over the 10-year period risen 20-fold. So I get asked a lot of questions. This is often what comes up when I start talking about the possibility that crude oil would move much, much higher, possibly all the way to $400 a barrel in a spike. And this would be less than a tenfold increase, and we've seen those sort of increases in that span of time before. Natural gas. I also expect natural gas is in the early stages of a 5-wave structure that would take us up through the end of 2026. It would started with a leading diagonal, and then it got the pullback for the wave 2. My final comments here, I'm running out of time, is on the U.S. dollar index. There's a lot of talk about how the U.S. dollar index is collapsing now. And on Hurst analysis, yes, I'm very bearish long term on the U.S. dollar index, but on the shorter term, I think we get a bounce, according to Hurst, out of an 18-month cycle trough up until October. So yes, this looks impulsive. So a 1 and then an ABC expanded flat to the upside. We also have sentiment suggesting that we would get a pullback in the euro next, because commercials are heavily short, retail's heavily long. And this is probably going to be a headwind for metals. There's a lot of talk about how silver is going to explode to the upside, but look at the sentiment on silver. Commercials heavily short, retail heavily long. That's a perfect storm of bearishness. So I think we're going to get a pullback on silver and gold during this move to the upside in the U.S. dollar. But what I don't think is going to happen is I don't think that's necessarily going to uh, affect energy as much. The energy is not necessarily driven by whether the dollar is moving up or dollar moving down. Metals are much more susceptible to moving down while the dollar is moving up. I'm expecting an actual rise in dollar between now and October. It's 8 or 7:50 or no 9:59 a.m. Eastern. I'm in the central United States, so just 1 minute to go. Just a reminder, go to the site. You can read about the subscriptions and things there. And my offer is email me at sid@elliottwaveplus.com. That's with two L's and two T's to receive immediate 50% refund off your first month of service, any price tier. This is for first-time subscribers only. Cancel anytime. Also, I'll mention to you, you can email me there and ask for my slides from today's and my documents from today's webinar. So, Jody, are you there?
I am here. Thank you so much. You left me with a lot to think about today. Fantastic presentation, Sid. Thank you as always.
Thank you for inviting me and have a nice rest of your day.
Thank you.